The picture here is a real picture. It's not photoshopped. This is a picture of a double rainbow over our mine in Western Australia. Can you still hear me if I walk away from the podium? Yes, good, good. And I want to assure you that it is real. It gives me a reminder of something on the soft side of things, that supposedly at the ends of the rainbows are pots of gold. But this isn't a gold story. This is about pots of zircon at both ends of the rainbow, and hopefully I can show you in between as well. There's about 5 slides that are really pertinent to the story. They're right up front. They tell the story, I think, and then there's a lot of detail which you may or may not be interested. The first one is that we start talking about a company with what I call a very strong asset base in the ground. This is the deposit. Strong for 2 reasons. First is location. This is located 80 kilometers north of the city of Perth in Western Australia, which means we're an infrastructure-rich country. We have people that drive to work in the morning and go back home at the end of each day. No mining camp. So location is very important. It allowed us to be a very low-cost capital startup company. Secondly, though, is the exceptional deposit itself. And as you hear the rest of the presentation, it'll come back to this point on several grounds. Firstly, it's a very high-grade deposit. From the standpoint of heavy mineral grade, it's basically twice as high as a standard deposit at around 3%. So we're talking about 7% plus on heavy mineral grade. But within the heavy mineral, this one is also zircon rich, and that means that's the value adder. Zircon, as you'll see in the next few graphs, generates about 80% of our revenue. In addition, this is a rich deposit because it's coarse grain. And what coarse grain means when you do gravity separation is the next 2 things, which is high recovery. Very, very high recovery of zircon and high recovery of titanium minerals. When the grain size is smaller, it's more problematic metallurgically. So a quality deposit. The second main thing is that this is a very low-risk business model. And what I mean by that is it starts out with simple open-cut mining, which is standard in mining in mineral sands for the most part. It's being operated as a mine by one of the best mining contractors in Australia, certainly in mineral sand space, called Piacentini. They've been around now for 3 generations. The second thing is that it's just simple gravity separation, simple model. And thirdly, we just make a concentrate. We don't go into the details of having to separate the final concentrate into products, which is a little more problematic, a little bit more costly. We use the simple model to get started. Now that we are started, we'll be starting to look at, do we have any value-adding aspects to come back to later? Right now, the answer is not so much, because we didn't leave a lot of money on the table to selling our concentrate. And as you can see here, with the ship, is that we sell this in bulk. When the ship sails from Bunbury in Western Australia, we already have the money in our bank. So we don't have any marketing. We don't have any concerns about product quality. The offtake agreements are for the life of the mine, sold into China, and they take what we make when we make it. We make pretty good product, but nonetheless, I'm not bound by requirements for minimum specifications, for example. Very simple model. Thirdly, we then delivered on what we represented to our shareholders that we would be doing. That is, firstly, construction, on time, on budget, $52 million. Very low cost because we had some special tricks of using used equipment. We delivered the project to get to production on the schedule that we said we would, which, by the way, our first month of production was December of 2018. So we're a new mining company. But what we did then was, it got better. In the second month of production, first of all, we did do it on schedule. The second thing was on second month of production, January of 2018, we already ramped up to more than 100% of nameplate capacity on HMC production. Fantastic performance. Originally, we had a 6-month ramp-up schedule. We cut it down to 4 months for the budget, and then we ramped to full production in only 2 months. Stellar production. And then, as you can see at the bottom of the graph, on the variety of aspects of performance for the first half of the year, we basically beat all our targets. Very, very strong performance. One of the main reasons we did, and this gets into a category that I'm calling unexpected positives, and there's a few of them to talk about. So we had a good launch, and then we had some better things happen even after that for shareholders. The first one, and the biggest one, is the fact that the ore grade has been coming in much higher than we expected. You can see here that for the first half, it's 43% higher than we expected based on the ore reserve. And we recognized early on, after just January and February, that something was wrong. We obviously don't know how to estimate ore grade. But we had to figure out why. And what we learned was that this deposit is actually even more special than we thought. It is a high-grade deposit, but in fact, one would consider it possibly ultra-high grade. There's a high-grade core that runs through the belly of the deposit for 12 kilometers. That is much higher than we thought. We did the standard drill spacing of 20 meters to assess it originally, 20-meter spacing between holes. And what we learned we had to do is go back and re-drill it, 5-meter spacings, to account for the high-grade variability that's in this deposit. I'm happy to tell you that all that drilling's been done, and we're currently reassessing the ore reserve and the mineral resources now. That will be released in the next quarter. And there's clearly no doubt the grade's going to go up. The question is how much. You can see here in front of you, 43% higher already in the first half, so it could be significantly higher, and that goes to the bottom line. The second positive is that within the heavy mineral, we're finding that the zircon content itself is quite a bit higher than we estimated. You can see here 12% higher in that first half. That also goes to the bottom line. Remember, 80% of our revenue comes from zircon. So this is plus plus. We now found, unbelievably, we talked about the pot of gold. I said pot of zircon. Literally, we had a discovery of a zone of ultra high-grade ore below the base of the mine. It wasn't picked up by the original drilling. It was only hit by happenstance that the geologist wanted to dig a trench to test some of the ground below the mine, and he hit this ultra high-grade layer that was running higher than our concentrate. 95% heavy mineral and 71% zircon. Nature did this. We're mining it as direct shipping ore, direct shipping concentrate. Talk about a pot of zircon. We've mined so far about 2,700 tons of it, and it's averaging somewhere around 78% heavy mineral. That goes right onto the concentrate storage pad. We've got a little bit of clay to clean out of it, and then there will be some special material. It's also full of premium grade zircon. So this is a very special little pot, and we know there's now other pots as we go to the north in the mine. A very positive thing. All these positives are being reassessed in this fourth quarter, and we'll have a new economic model and some new projections about the overall financial outlook for the company by the end of the year. In February, we released market guidance for the calendar year of about $40 to $50 million for the year of EBITDA, earnings before interest, tax, depreciation, and amortization. And in July, we've already upgraded that guidance for the year to 55 to 65 million, because we could see that we had this extra grade and zircon content that was playing very favorably for us. And we have an estimate for 2020 based on the old ore reserve of almost 100 million, 90 to 100 million EBITDA. So things are going to get very exciting next year one way or the other, but I predict that because we are going to be upgrading the ore reserve, it's likely going to be higher than what we're projecting currently, forecasting for 2020. The point about the graph is up, and away. We're well on our way on some very positive things coming out of the deposit. I do expect that the ore grade and the zircon content will be increased in the ore reserve. I also expect the ore reserve tons will increase somewhat because it hadn't been upgraded since the bottom of the market when we did the original feasibility study. So we're going to be optimizing cutoff grade, and we are quite confident with new commodity prices, which are a lot higher than the feasibility study, that other ore will optimize into the model. This is a snapshot of the highlights of the corporate group as it is. You can see the share price graph's done quite well for us. At the very bottom where it was is where we raised money for the capital raising, and so our shareholders have done quite well so far. But I can feel very confident to say this: we've got a long way to run yet. You see, we do have a little bit of debt, $67 million. We also have a lot of cash, $30 million already in the bank, which doesn't include 14 from a shipment that happened at the end of August. We received it in September, so it's not counted. By end of January, we'll be cash neutral, and that means we have an opportunity to pay off our debt quite a bit earlier than we anticipated. In any rate, the debt's paid off in a full 3-year term, which started back in April of 2018. So in any respect, if we run by the normal, it'll be gone in April of 2021, but the fact is we'll probably negotiate an out earlier. $260 million market cap, 27 cent share price. We had a little glitch down for just a few minutes, or for a few weeks here, after our biggest competitor, Iluka, announced that they were seeing some softening of zircon prices. But in fact, that's not about softening prices for image, that's just for Iluka. And so by now, we've gotten the message back out. We have not seen a softening of zircon prices. There is, in fact, a fundamental supply deficit for zircon that will go on for the next few years. So I think price pressures will continue to be positive. The rest of these slides are just detailed, so I'm going to get through a few of them, but it doesn't matter. I will absolutely keep you on time today. I'm saying here in our projects types in Western Australia, we have 2 types. Those can be mined by dry mining method, like we're doing at Boonenaring, and that's in the orange ovals, and those that can be mined by dredge mining techniques, which is a lower cost mining method. Importantly, we have a few extra opportunities, and probably most people have within their own portfolio, for developing a second operating center. The value accretion that we're talking about so far in the market and to come next year is all about the first project. We've got another few to look at, and frankly, Bidamina, the one that's just next to Boonenaring, is the one that's high on my list, because it, like Boonenaring, has some very special qualities that I think makes it much more than a stock standard mineral sands project. So it's going to be our focus as soon as we get through expanding the mine life at Boonenaring where we are. Quick snapshot of some of the ore reserves on the books. You can see the high heavy mineral grade. You can see the high zircon in the case of Boonenaring. These graphs just show you that what's in the ground is predominantly still ilmenite, the yellow, but quite a bit of zircon by comparison to a stock standard mine. And you can see that the value per ton of these various products is very much in favor of zircon, $1,500 US per ton. And so the combination of the percentage of mineral in the ground and the rate the value shows you that we get most of our revenue from zircon, and that's exactly how it's working out. I think today our year-to-date is probably about 82% revenue from zircon. Base assumptions on the project itself, the 500 tons per hour is actually one of the smaller mineral sands projects that you will hear about. However, because we have such high heavy mineral grade and rich in zircon, on a revenue basis, this project punches 4 times above its weight. It acts more like a 2,000 ton per hour project if it had more standard grades. The base case around the first 5 years of production, which are on the books, you can see how much zircon we're planning to make per year, 60 to 70,000 tons. I expect that 70,000 tons for 2020 is probably undercooked now that we see that the ore grades will likely be coming up higher. Watch for the updates later in this year. We currently have 5+ years of mine life, but we have clear extension capabilities to add to this mine life. I'll just flash some of these in my last 40 seconds about some of the performance. The green is actuals versus the blue. You can see how in the second month of operation in January, we quickly skyrocketed above our long-term average production. We're actually 2.5 months ahead of schedule so far for the year in production. Ore grade, same story, much higher than we expected, especially in the first quarter. Overall, we're still 33% higher than we expected. And in the zircon content as well, we're currently higher than we expected. This is just another snapshot of the guidance that we publish, some more of the detail. It's on the website. I've got a book at my booth. Come by. And the last thing to close, because I'm out of time, is that we are also installing a solar farm at the project. We don't have to. We're grid connected. But today, if you didn't know, solar power can compete with grid power. We'll have about 25% of our electricity coming from this plant, and we didn't have to pay for it. We're just having to buy the electricity. And it's given us a little bit of green footprint. Thank you very much.